Apple just delivered its best ever fiscal quarter, and the market reaction says a lot about where tech stocks might be headed next. In this video, I'm breaking down Apple's most recent earnings report, take a look at the charts, discuss the 3 biggest risks to the business, and I'll give a 1-year price target for the stock. Let's generate alpha. Here are the headline results. Apple reported record quarterly revenue of $143.8 billion, up 16% year over year, beating Wall Street expectations. Earnings per share came in at $2.84, which was also better than estimates. Here's how the major product segments performed. iPhone revenue was $85.3 billion, up 23% year over year. Services revenue was $30 billion, up 14%. Mac revenue was $8.4 billion, down from last year. iPad revenue was $8.6 billion. Wearables and accessories did $11.5 billion. These numbers show strong demand for flagship products, especially iPhone, while other hardware segments were more mixed. Apple's latest earnings delivered both growth and some challenges. Record revenue and EPS beat expectations, but not every segment was strong. For investors, the big takeaways are iPhone's strength, services momentum, and how Apple positions itself in a shifting tech landscape. Let's take a look at the charts. Apple is slightly below the 50-day moving average, which usually means short-term momentum is a bit soft and prices fighting resistance. The current price is well above the 200-day moving average, which generally signals the long-term trend is still bullish. The 50-day is above the 200-day, which is typically a bullish longer-term configuration. The short-term is choppy, below the 50-day, but the bigger picture still looks constructive, above the 200-day. The relative strength index is at about 45. That's neutral to slightly bearish, meaning momentum isn't strong right now, but it's not in extreme territory, not overbought or oversold. Key levels to watch from here. Reclaiming and holding above the 50-day often improves the short-term tone. Long-term, the 200-day is a major support level traders watch. Make sure to keep an eye on this indicator if you're following Apple stock. Here are 3 of the biggest risks currently facing Apple's stock, factors that could materially impact its share price. Despite its size and diversification, Apple still relies heavily on the iPhone, which generates around half of total revenue. The risk? Smartphone markets are mature, consumers are holding onto devices longer, and incremental upgrades feel less like must-haves. If future iPhone cycles fail to excite consumers, revenue growth could stall quickly, and Apple's stock often reacts sharply to any sign of iPhone weakness. Apple's high-margin services business is a major growth driver, but it's also under increasing regulatory scrutiny worldwide. Key risks include antitrust investigations into App Store fees, potential changes to revenue-sharing models, and pressure from governments. Any forced changes to Apple's App Store economics could directly hit margins. Apple has been more cautious and quiet around AI compared to competitors like Meta, Microsoft, and Google. The risk isn't that Apple lacks resources, it's that investor expectations are extremely high. If Apple's AI rollout feels slow or underwhelming, the market could reprice the stock lower due to perceived innovation lag. In today's market, tech leadership is closely tied to AI, and falling behind, even temporarily, could impact valuation. Now the big question, where could the stock go from here? Most analysts maintain a buy rating with an average price target of about $300. Looking at the discounted cash flow model, the base case estimated value for the stock is about $141, and the best case is $246. Please keep in mind that DCF is highly sensitive to assumptions. Even small changes to growth or discount rates can swing the fair value dramatically. As for my opinion, I am giving Apple a buy rating with a 1-year price target of $300. Here are 3 reasons why I believe it's a buy, especially for long-term investors. Apple isn't just selling products, it's selling an ecosystem. Once someone owns an iPhone, they're far more likely to buy AirPods, an Apple Watch, a MacBook, and subscribe to Apple services. This creates sticky customers who are less likely to switch even if cheaper alternatives exist. That loyalty translates into predictable revenue and long-term stability, something investors love. Apple generates enormous free cash flow, which gives the company flexibility most businesses can only dream of. They use that cash to buy back shares, pay consistent dividends, and invest in future innovation. Share buybacks reduce the number of shares outstanding, meaning each remaining share becomes more valuable over time. This quietly boosts long-term returns without needing explosive growth. While hardware still matters, Apple's services segment is becoming increasingly important. Think App Store, Apple Music, iCloud, Apple Pay, and subscriptions. These services offer high profit margins, recurring revenue, and less dependence on iPhone sales. As Apple continues to monetize its massive user base, services help smooth out earnings and strengthen the business long term. To wrap it up, Apple is still a buy if you're thinking long term. The company continues to generate massive cash flow, has one of the strongest balance sheets in the market, and keeps rewarding shareholders through buybacks and dividends. Apple's ecosystem, brand loyalty, and expanding services revenue give it durability that few companies can match. Thanks for watching. If you enjoyed this video and want more earnings recaps with 1-year price targets, please like and subscribe. Until next time, keep earning, keep saving, and keep investing. I own Apple shares through an ETF. This is not financial advice, just my personal opinions. Make sure you consider your own risk tolerance, time horizon, and financial situation before making any investment decisions.